So now, um, if we look at that question, the way it is starting to give us the information. So we have the sales units per year. We've read them, the amounts, 300 year one, 410 year two, 525 year three, then 220 in year four. We have selling price per unit, year one, 125 and all that. Variable cost per unit also given. Annual fixed cost is also given. And annual fixed cost is given in thousands. You see the bracket part there? That is important. Additional information, uh, selling price and cost information are in current price terms before applying selling price inflation of 5% per year, variable cost inflation of 3.5 per year, and fixed cost inflation of 6% per year. Ladies and gentlemen, I want you to look at that additional information one, and already we should start thinking of what direction the examiner is taking us. Now, we are being told that selling price and cost information. So if you look at the data we have above, we have selling price per unit. We also have the number of units, right? So this selling price and then the cost information. How many elements of cost do we have? Variable cost and fixed cost. Those are the elements of cost that we are being given there. So this price and cost information given, they are given in current price terms before applying inflation, variable cost inflation, and fixed cost inflation. So these are net of inflation effect on them. So we already should think, what is the effect of inflation on selling price, on variable cost, and on annual fixed cost? We know what inflation is at this level. So we are going to handle that. Let's look at additional information number 2. Tobin Limited pays annual corporation tax rate of 30%, with the tax liability being settled in the year in which it arises. Right? Good. Note 3. The company can claim tax allowable depreciation. The company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% straight line basis. So that information is a good reminder for us that before we charge tax, let's take care of depreciation. We are handling financial management, and I want to believe, because we've also done financial management at intermediate level, financial management at advanced level, we understand how to handle this allowable expense like depreciation when computing tax. There are two approaches. Just like any other computations that normally have different approaches, where you can go in the route of depreciation tax shield benefit, right? Or you can just compute it on a straight, simple way where you deduct your depreciation, charge your tax, then you add back your depreciation. Those are two approaches. So you can go with the approach you're comfortable with, but we will choose that which everyone can be able to understand easily. You get that? So there is depreciation tax shield benefit route where you just, just add the tax shield benefit and you're good. Or you deduct depreciation, charge tax, add it back. Good. Note 4. The company's investment project is expected to have zero residual value at the end of the 4 years. We know what residual value is. That is like salvage value. Residual value is the same as salvage value. So it normally comes at the end of the project life. So our project is running for how many years? 4 years. You can see from the start of the question, the project life is expected to be 4 years. So that's where the salvage or residual value is coming in. And normally you recoup back, you recover. Yeah, that residual value, we normally add it because it is something we recover when we dispose of the asset. Note 5. Tobin Limited has a nominal after-tax cost of capital of 12% and a real after-tax cost of capital of 8%. Ladies and gentlemen, look at note 5. What information is the examiner trying to bring on board? Tie it along and tag it with note 1. Note 1 was presenting an information about price, selling price, and the cost items, cost elements, which have been given net of inflation effect. Now in note 5, the same examiner is bringing on board nominal after tax cost of capital. The word nominal being used there. And then real. We have nominal, and then we have real. So whenever you see those two terms, you should already be thinking of something. The examiner is trying to bring on board something there. We are going to see it. Note 6. The general rate of inflation is expected to be 3.7% per year for the foreseeable future. Now, tie the three notes, note 1, note 5, note 6, and then combine it with the general inflation rate. And now you realize that the examiner wants us to do some adjustments for inflation. And as a financial management student who has also passed advanced financial management with flying colors, you should be very, very, very good with this adjustment. Required the nominal net present value of Tobin Limited's investment project. Good. Now, did any one of us here in this meeting try to attempt this question? Did anyone try to attempt it? Because I had given you the file, and there could be someone who must have tried handling this question. Is there anyone who did that? Is there anyone who tried it? Yes, Becky. Becky, you see, you passed your AFM with flying colors. Yes, you passed it with flying colors. So that's why you already know it is Fishers. You already know it is Fishers, which is very good. Which is very good. Did you attempt it? I see already there is someone who attempted it, which is very good there. Someone attempted it, which is very, very good there. Uh-huh. Anyone else who tried it? Anyone else? Anyone else? Catherine is asking which question? Catherine, this is very dangerous. You don't know what we are looking at. Were you there in the last two sessions? In the last two sessions, for Monday and Tuesday. Today is Wednesday. Have you been in any of the sessions? Then you should have this question with you. I shared the files in the WhatsApp group, so kindly check it out. Check the files shared, then you'll be able to see a file written BDA mock August 2024. You'll be able to see it in the WhatsApp group, so you get it from there. Catherine, I hope we are together. I hope we are together. Get to the WhatsApp group and you'll find it there from the attachments. Unless you are not in that WhatsApp group, which can be dangerous, but okay, good. Now, let's continue. Now, for the members who tried this question, that is who? Let me see, that is Sammy. Amos, and Becky, you've also tried it? I can see you wrote yes there. You also tried it? Lisa is saying things were going on so well until Note 5 came in. Oh, Amos did not. Okay, I think your yes was a response to something else. Okay, all right, all right. Lisa, worry not. Lisa, worry not. We are here to remind ourselves. Now, I want us to attempt it, and then we will compare notes with the member who has tried it. So far in this meeting, I'm only seeing one person tried it. That is Sammy. So, Sammy, you will compare notes, check through what you've done as we do it together. Then you tell us what you got. Daisy also tried. That is good, Daisy. So, the good thing of trying them on your own is that even if you make a mistake, worry not. You just do it. I mean, there is nothing wrong with that. If you do a mistake, you shall have known what not to do. And that at that point, you're learning. So we will be comparing notes with the members who did it. So far, I'm seeing Daisy and Sammy, so that we see how you went about some of those areas. Good. Now let's
Also
start.
tried it a bit.
You also tried. That's good. That's good. So I want us to keep tabs and compare notes as we move along. Now, let's look at the question and start. You have seen additional information got me stuck. TMK. No, you cannot get stuck like that. No, this question is a very brief question, but it just has the examiner just brought it in a different language. So, like I always insist, guys, the most important thing is having an idea. That is the most important thing. You must not get everything 100%. No, even all of us in this meeting, from all the levels you've passed these CASNEB exams up to this level, now you are in your final, the very final exit paper. It doesn't mean that you've passed because you got 100%. No, you just passed because you were able to achieve the pass mark. That is it. Yes. So worry not about when you meet such questions. Don't even panic. The reason is you don't have to score 100%. The only thing is just have an idea and know how to handle certain issues. When you get somewhere where you cannot really proceed past that, leave it there. You shall have scored good marks. Now let's see. Now, if to handle this question, I want us to just summarize what the examiner is bringing on board. Now that if you look at the required, we are required to get the nominal net present value. Yes. So this is a project, and the project period is 4 years. And this project, we are given projected forecasted sales, uh, forecasted prices that they will charge, forecasted volumes that they will produce, and then these people have also given forecasted costs in terms of variable cost and fixed cost. We know that when you talk about total cost in any element, now that you've done management accounting, you know that total cost is composed of fixed cost and variable cost. And I want also to believe that we know the elements of variable costs. We know the elements of variable cost. Yeah. So with this information, the examiners will bring on board projected figures. This is a projection. This is forecasting. Remember, we did forecasting before, forecasting of financial statements. And forecasting, I told you, forecasting in real life, even where you work, for those of us who are working, even wherever you work, you know very well there is something called budgeting. Budgeting. Budgeting is the practical application of forecasting of financial statements. Because in budgeting, you will project what you expect to spend in the next financial year. When the year is just starting, now you come up with a budget. You say, we will need to spend on this budget line this amount. Then you also project the expected incomes given your past patterns. You check your past patterns, for example, your performance in the last 3 years, you get an average of it, and you can confidently say that in our product A, we expect, given the measures we have in place, we expect these sales to either improve by this figure, by this margin, and therefore we can confidently say we budget to get, for example, 20 million from this product A in this financial year 2025. That is budgeting. Whatever you are doing is just forecasting and coming up with future forecast figures. That is what the examiner has given us here. The language is a bit different, but it is the same thing. Now, when we do forecasting, remember, we know time value of money. Now that we are covering financial management, we know what time value of money means. Time value of money means, the value of money today is different from the value of money tomorrow. And that forms the essence of even loans. Whenever you go to secure loans from any financial institution, as much as they're charging you the cost of borrowing, the cost of using their finances, the cost of finance, as much as they're charging me the cost of finance, they must bring on board element of inflation adjustment. They must bring on board element of inflation adjustment, because they know very well that the value of whatever finance you'll bring on board, if they give you 1 million today, If you bring that 1 million after servicing the loan, for example, in 3 years, the value won't be the same. So they will charge you the cost of borrowing, but within that cost of borrowing, the interest fee they charge you, they must put into consideration inflation adjustment. That is something that we should be all aware of as finance students. Now, having looked at it in that perspective, that forms the basis of note 1, where we have to adjust for that inflation to take care of the changing value of this money over time. Given that we've already known we are dealing with forecasting, we are dealing with some sort of budgeting that is in real life application. Now, when we talk about the costs, we've already known the elements of cost. Yes, we know there are fixed costs and variable costs. So I will not go into too much details about costing because that's something you've done in your MA. So we are good up to that point. Now, let us have the skeleton of this information put down together. Now, this project, we have initial cost. How much is the initial cost given? At the start of the question, we are told the cost is 20 million and it is payable in full at the start of the first year of operation. So that is where you're putting in your investment, your initial investment. So initial cost is 20 million, like that. With the initial cost, now I want us to put this information together. The information given here for the projected sales costs and the volumes. This information, let us now arrange it in order and let it be understood. How do we arrange it in order? Let us look at, the sales figures. We are looking, we have to get to the sales. We have to get the total variable cost because we've been given variable cost per unit. We've been given selling price per unit. And again, we have the number of units. So we have everything we need. The only thing is to organize it together in good format. Fixed cost, usually they don't say fixed cost per unit. No, fixed cost, you know what element it represents. So let's put the information together step by step. Now, to put it together step by step, we know the project life is 4 years. So let us list the years. Year 1, year 2, year 3, and year 4. That is the project life. Yeah, those are the years. Then let us bring sales. Sales in units. We're just transferring information, but now putting them in good order that we can work with them. Sales in units, we've been given here. We're just transferring the figures the way they are. We have 300,000. 300,000, I can just even go and refer to it. I don't have to type 300,000 all the way to year number 4, where we have 220,000. That is one. Then we've also been given selling price. Selling price we've been given, and we know the selling price given is selling price per unit. But now, as we bring on board the selling price, I want us to remind ourselves of what the examiner said in note number 1. Let us all go to note 1 and see what the examiner told us. Selling price and cost information are in current price terms before. This is before. In fact, let me just highlight this word because this word changes everything. If you don't look at it well, then whatever your computation will not be correct. These costs are given before applying selling price inflation of 5% per year, variable cost inflation 3.5, and fixed cost inflation of 6. So we have to incorporate and consider the adjustment for inflation of these elements. Units, the number of units are not affected by inflation, as we all know. Number of units is not affected by inflation. Selling price is affected by inflation. So let us do the inflation adjustments straight away from that point. How do we do it? Year 1, let us subject selling price with this adjustment of 5%. So we will say the selling price is 125 for year 1, as we can see that. Then remember the way we were doing forecasting. It is the same format we are using. We are just adjusting growth rate. We are just applying growth rate. We just in a way we are saying the selling price per unit will be growing by 5% so that it takes care of that inflation. as we do our projection, so that whenever inflation adjustments will take effect, the value of money won't be affected at that time. The selling price won't be affected because we've already taken into consideration the inflation adjustment. So into bracket 1 plus, what is the inflation rate? It is 5% for the selling price. That's the adjustment we do there. So at this point, because I've typed in my 5%, I'm not locking anything. And I've referred to that cell where we have selling price for year one. I also don't log because I expect to drag to autofill for the 4 years. So I just confirm, control enter like that. I have now the new price that is taking into consideration the inflation adjustment. From 125, now it is 131.25. So if we apply the same for all those other selling prices, I'm now having my prices after adjustment for inflation. That is the first point I want us to understand. We go to the next bit. Which bit is it? Now let's move to variable cost. That is the next element. Good, variable cost. Now, again, in the same note one, the examiner told us there is also an adjustment for the variable cost. By how much? 3.5%. 3.5%. So we do the same. We go there and refer to the variable cost per unit like that. Variable cost per unit like that. Then we apply the same approach of applying that growth rate or applying the adjustment. Which adjustment is it? 3.5%. That is the inflation adjustment. Because I've typed in my 3.5 again, I'm not locking because it's already fixed. It won't change. Yeah. So control enter. I have my adjusted inflation adjusted variable cost per unit. Let me just add per unit here so that it doesn't confuse somebody. This is per unit. This is per unit. My cursor has started bringing me some little issues here. Let me just take care of it. Good. All right. Per unit like that. Now, we have adjusted our variable cost per unit after considering inflation adjustment, and now it is 73.485, like that. So because I've already set that formula, I'll just autofill for the 4 years, and I have it like that. Those are the variable cost per units after adjustment, after applying the inflation adjustment. The next element, which one is it? We have now annual fixed cost, annual fixed cost like that, annual fixed cost like that. Now, the annual fixed cost, we also refer to the same note one. You realize it is also affected by the inflation adjustment. So let us go ahead and apply the inflation adjustment. But I want you to take note of something. I want you to really take note of something, because if you are not keen and you overlook this very simple element, then you can do everything right, but you won't be able to score because your entries won't be correct. Just because of overseeing or overlooking, just overlooking one element. Which one is it? Look at annual fixed cost that was given in this tabulation. It is annual fixed cost. The figures are there, 3,000, 31, 32, and 3. But there is some thousands in shillings in a bracket. You see that? Ignoring or not taking care of that 1,000 will cost you the whole of these computations. So let's make sure we take care of that 1,000. So we bring on board annual fixed cost, and we say this annual fixed cost, we also adjust it by the inflation effect. And we've been told in note 1, it is affected by inflation at 6% per year. 6% per year. So first, I will refer to the annual fixed cost. Then ensure I first adjust it by the 1,000, because these figures are all in thousands. How do I adjust? Just multiply by 1,000 like that. So that is the first adjustment. Before I apply the inflation rate adjustment, I first make sure my figures are in correct level of precision. After that, I again now multiply whatever I'm going to get there by the inflation adjustment, which is 1 plus. What is the inflation adjustment rate for fixed cost? We are given here in note 1 as 6%. So I bring on board 6% like that. I close my bracket and then I confirm, control enter. Now, the figure I have there has now taken care of inflation, adjustment. And we've also taken care of the 1,000, right? So because of that, I can just autofill to the rest of the years to year number 4, like that. Are we together up to that point? Confirm to me that we are together. Confirm to me that we are together. Very good, very good, very good. I see we are together. Very good. Very, very good. Okay. So if we are together up to this point, then we are on the right track. Because I want us to be on the right track and understand. Understand. That is the most important thing. Yeah. So I'm just putting my comma style here. I'm not adding anything or deleting anything. I'm just doing some formatting so that my figures have the comma style with them. Good. Now, after putting this information, you know, we were given skeleton information. We were given skeleton information interconnected with all information. You can see all information from the start of the question to note 1. You know, there are
Excuse me, sir.
informations put scattered, but we are now putting it in order. Is someone asking something?
Yes, it's me, Eric.
Yes, Eric, go ahead.
Mine is giving me 3E plus 06.
Sorry.
I'm saying mine is giving me 3E plus 06, the annual fixed cost.
The space is not enough.
Just adjust
Okay.
your columns. Just adjust your columns.
Adjust the column.
Okay, thank you.
Yeah, just adjust the column. It will fit in. Yes, it will fit in. Good. So, okay, Esther, even I'm seeing Esther is telling you to adjust your column space. Okay, good.
Yeah,
Now,
it's okay.
okay, good. Now, the next thing I would want us to look at after having that structured information in place, let us look at these other additional informations and see what else do you think is going to affect the value of our investment? Now, we are looking at an investment, and I want you to picture the investment in your mind. This project that this company is trying to appraise, you know what project appraisal is. You want to appraise a project, yeah? And to appraise a project is to, you know, to make a decision by evaluating this project and get to see if the project is worth investing in. Is it viable? Is it worth of an investment, or it is not viable? So as you do your appraisal, we've already seen one of the things you consider when appraising a project before you make a decision to invest or not, you must consider inflation adjustments into the future. And that is what we've done here. We already have all elements in place. So we are looking at what factors will affect the value of our project or our investment within the period that it should take. We've considered inflation. Now, if we look at this additional information, so let's ask ourselves, what other thing do we think will affect? What other element do we think will affect the value of our investment as we move forward across the 4 years of project life? Note 2. Let's look at note 2. Note 2 is just about tax. Note 2 is just about tax. And then we are just being told that the tax liability is settled in a year in which it arises. So this tax, we know the elements or the point where we'll bring in tax, right? When we'll be chasing and to look for our cash flows, because we need to get our net cash flows as we try to compare expected revenues, we knock off our costs that we expect to have. Then now at the point where we will look for our net cash flows and we get to see if the project cash flows will be viable or not, tax will always take effect into whatever returns we get. You know, whenever you get your revenue, tax will have to apply from it, right? Now, let's look at note 3. So that tax will affect it, but not at this level. Let's look at note 3. Note 3 is telling us the company can claim tax allowable depreciation on the full initial investment of 20 million on 25% straight line basis. So there is some tax allowable depreciation. That's where I was telling you there are normally 2 approaches, and you are free to go with whatever approach that you feel comfortable with. Good. I'm seeing Eric and Ruth are giving us an element that is affecting our project, and it is depreciation. I can see both of them are giving us depreciation, which is very good. So if depreciation is an element we have to look at because it will affect the value of our investment, which is true. All of us agree that inflation will affect, depreciation will affect the value of our investment. So let's go ahead and work out this depreciation given note 3. Given note 3 that we've been given there. And let me see, note 4 is having what? The company's investment project. That is residual value. Note 4 is about residual value. Note 5 is about cost of capital. Yes, cost of capital adjustment. So that is okay. Before we reach there, let's look at depreciation. So I just want us to bring some computations of depreciation here. So computation for depreciation. Computation for depreciation adjustment. So let us see, how do we compute and what effect will this depreciation have on our investment? And here I want to employ a direct approach of handling this depreciation. The way depreciation is going to affect our cash flows. Given note number 3, we've been told the company can claim tax allowable depreciation. You see that part? I've given you 2 approaches, but I want to pick that approach that I believe no one will have a problem with. But I'm giving you a go ahead. You are free to go the shortcut route where you simply go ahead and add your depreciation tax shield benefit. You can go ahead like that if you're comfortable with it. But I'm avoiding shortcuts so that everyone understands step by step. Whenever there is a mistake, you'll be able to go back and pinpoint it. So let us work for our depreciation on this investment. And to work for the depreciation, let us bring on board cost of our investment. And because we are dealing with a project running for 4 years, those years are very important and we will always move with them at each and every stage. So there are 4 years like that. After listing the 4 years, let us look at the cost of our project. Remember, cost of this project or the investment will not be affected for the 4 years. We were told the project will cost 20 million from the start of the question. You look at that part. Now, that cost, 20 million, will be the same for all the 4 years. It's not going to change. Unless the examiner tells us it's going to change, we don't assume. Cost remains constant. All of us know at this level. You've done published accounts. You started with financial accounting. You did published accounts. You've done advanced financial reporting and all that. And you know whenever you prepare statement of financial position, those non-current assets, elements of PPE, their cost will always remain constant. Yeah, the cost is constant. The only adjustment you do to the cost is depreciation and any other element affecting it. But you must always refer to the cost. The cost will always be there constant so that you compute from that cost the depreciation. So that's where we start from. So the cost of our investment here or our asset here, asset base here is 20 million. So that's where we start from. Like that. It is 20 million. 20 million. So it is the same 20 million here. 20 million here. So I think I can just drag them. I don't have to. Now if I drag, it's bringing, and I don't want to complicate this thing at this point. 20 million. Good. So with our cost of investment, 20 million for all the years like that, if I put a comma star, I'll be able to see if there is something. Okay, I think the first one is 2 million. Like that. Good. So that is the cost. That is the cost of our project, 20 million, like that. Now, what is the next step? We want to compute depreciation. That is our objective. To compute depreciation, we know depreciation affects the value of our investment. We know depreciation affects assets, right? We know depreciation affects assets. So we have to bring depreciation consideration here because it will reduce the value of our investment. And that is where we will get the net book value for our investment. Then we'll get the net book value for our investment. So how do we apply this depreciation adjustment? How do we apply depreciation adjustment? Let's see what procedure, what method are we applying depreciation? I think that was given in note 3. Let's look at note 3. The company can claim tax allowable depreciation on the full initial investment of 20 million. That is the investment. That is the cost of investment. We have it here on a 25% straight line basis. You get that? So let us apply this depreciation charge on a straight line basis. So this is always the simplest approach of computing depreciation because it does not involve any adjustment for accumulated depreciation or something like that. We have reducing balance, method of computing depreciation, and we have direct. So in this case, it is direct. We just charge 25% on cost. So let us go ahead and charge 25% on cost. What costs? In year one, it is 20. So meaning what? Because the costs are the same, depreciation charge per year for the next 4 years will also be equal amount. So I'm getting 5 million. So it is the same 5 million that will apply for the 4 years. Each year, 5 million. Each year, 5 million. That is the straight line approach of computing that depreciation. So if we compare and we deduct the depreciation, is someone speaking? Is someone saying something? Or someone unmuted and forgot to mute back. Let me see. Okay, I think the noise is gone, the interference is gone, so we proceed. I'm seeing some chat here. How is it 20 does not... Diana, 20 is the cost of the investment and depreciation is going to affect. That's why we are charging depreciation. Yes, depreciation affects the value of our investment. That's how we are going to get the net book value of the investment per year. So we are getting the net effect. We are getting the net effect. What is the net effect? We are deducting the cost, the depreciation charge for the year. So we have 20 million, the cost, then we deduct depreciation. So we have net book value of 15 million per year. That is the net book value that will appear in the statement of financial position. Now,
Olim,
yes,
if we have year 1 to year 4,
yes.
it means in the year 4 we are not going to have net book value
Why?
because it will have depreciated up
Not
to
depreciated
zero.
completely.
No, it's okay. We are yet to reach there. Remember, I want you to look at this thing in a perspective where, yes, as much as I'm explaining computation of depreciation using an example of a statement of financial position, as much as I'm using that to explain, do you know the reason why I used the statement of financial position to explain this is for you to understand the effect of depreciation on assets. Now,
Okay.
look at a perspective where we are now handling a project. We are not preparing statement of financial position. We are looking at a project and our motive is to do an appraisal. We are doing project evaluation. Project evaluation is depending on the cash flows. What cash flows are we expecting to receive? Remember, you're an investor. You are asking yourself, now, is this a viable project to invest in? I'm given projections here. Kindly advise me if this project is viable. Now we are working with projected figures, right? So we are not preparing statement of financial position. This was just an aspect of understanding. Do we get that?
In fact, it has been given in note 4.
Good. So I hope we are together there. Good. Yeah, in note 4, he's saying the company's investment project is expected to have zero residual value. So we are going to get there. Don't worry. Step by step.
Mwalimu,
Yes.
in which instances do we do, like, for example, now we charge the depreciation in the 20 million, which was
Sorry, go ahead.
in which instances do
Yes.
we do, like, the first year tuna charge 20 million, the next year tuna charge 15 million?
No, we are not charging 20 million depreciation. The cost remains constant across the 4 years. Yeah.
Because it's on a straight line basis.
It is on a straight line basis. We are
Maybe
just charging.
the reducing balance is where they vary.
Oh, she was asking about reducing balance. So reducing balance is where you have
Yes.
now to consider accumulated depreciation. But in this case,
Yeah.
this is straight line. So I
Straight
hope,
line basis.
yes. So I hope, I guess I saw the name Diana. I hope, Diana, you are good with that. You get it,
Yeah, I'm
Dan?
good. Niko na mtu ananisumbua hapa. So
Oh,
when you are told that in a straight line, the cost remains constant.
correct.
Yes.
That is
Don't
true.
like minus the depreciation when you go to the next year.
Yes, so if it is straight line, always refer to the cost. The cost is constant, it does not change. Unless it is
Okay, thank
reducing balance is where now the cost in year one, you reduce the depreciation in that year. Now, whatever charges of depreciation in year two, you have to take care of the depreciation in year one. You have to knock off the 5, you remain with the value as 15, then you charge depreciation again. So you reduce it as you move from one year to the next.
Thank you.
All right, so let's continue. Now, after putting this information into this organized format, now we can ask ourselves, we want to now appraise our project. And we appraise it using net present value project evaluation technique. To evaluate the project using NPV, we must have net cash flows. We are dealing with cash flows. I believe you know how we normally compute NPV. We work with cash flows. So from this information, let us come up with cash flows. How do we come up with cash flows? We have to look at our revenue projection. We have to look at revenue projections, what we are expecting to get. We have to consider the costs. And then we have our net cash flows after also taking care of tax. And we've already computed depreciation because those are things that will affect our cash flows. So that after getting net cash flows, we can comfortably go ahead and compute our net present value. So let us do that. Let us do that. So how do we do that? We start by listing the years. The years are there, so that one will always remain constant. The years are there, will always remain constant. We have 4 years, so we must always make sure we organize our information from one step to the next. Now, as we do that, I want to bring the initial year, because we are working with cash flows and we want our NPV. You know how we normally compute NPV. It is the present value of cash inflows. We deduct the initial investment. Some other times it is called present value of cash outflows. See, I believe we know that. So because of that second bit, I want to bring year 0 here, where we are doing our investment. This is the point where you are spending money, where you are starting your investment. Your 20 million will come in at this point. After the 20 million, now you ask yourself, what cash flows am I getting for these years? Then I compare with what I'm spending today to see if my project will be viable at the end of the 4 years period. So we have to look at it in that perspective. So where do we start from? Initial investment. Because that is where we are spending money. How much are we spending? We are spending 20 million. That is the money that we are spending from the start. That is the money we are spending from the start, like that, 20 million. I just want to remove these decimal places. I don't think if they're necessary for us, but we can either keep 2 or just let it be like that. But usually, it's advisable to just have 2, so it's okay. Now, that is where we are spending the money, our initial cash, our initial investment, our outflows is at year 0 from the start. Now, after we spend this money, we want to evaluate this project and appraise it. So our interest is to look for money that we are going to get after this period. How do we look for it? Let us bring now on board the information from the projections given to look at our forecasted revenue. So we start by computing revenue from that point. How do we compute revenue? We don't have revenue in year 0 because that is where we are doing investment. Our revenues, we start computing it from year what? From year 1. How do we compute revenue? We know the elements that make up our revenue. We know we have selling price per unit up here. You see, we adjusted our selling price with the inflation effect. So we have our selling price per unit. And at the same time, we have the number of units that we expect, the projected sales volumes in units. We have 300,000 for year 1, for 10 for year 2. So those 2 elements is what is going to give us revenue for each and every year because we have them across the 4 years. So that's how we are going to compute revenue. So just go and put an equal sign. Then we multiply the number of units. The number of units that is expected to be produced in this project, and then we multiply it by selling price for each of those units to get the total revenue. So I confirm, control enter, and I'm having my revenue for year one as 39,375,000 like that. Now, because I referred to those two, I do not have to repeat referring to all of these ones. Now, after setting that formula, what I do is just to drag it to year number 4. And I'm having my figures like that. That is how we are getting revenues for the 4 years. I hope we are together. The next thing, after getting revenues, we are appraising a project. When appraising a project, you are looking at the net returns. The net returns, that is your interest. And for you to talk about net returns, you have to take care of all your costs. What expenses are you likely to incur? Are you likely to incur throughout the project life? And one of it are the costs given. We have costs that are all categorized under variable cost. We have all those cost elements categorized under fixed cost. We know them. We know them. In real life, costing is always part of us. Costing is part of us. Even you as an individual attending this meeting now, you know in your household, if someone asks you, what is your monthly expenditure in that your house? You can even tell. You know the minimum amount you need to survive, right? That is costing. So as much as we are learning these things even apply in our lives. You know rent is constant in your house. You must pay rent, and the amount is already agreed and discussed with the landlord if at all you are staying in a rental house. That is a fixed cost. Yeah. So those are costs. If you have some subscription that you normally pay and the amount is already constant, that is a fixed cost. Then we have some other variable costs like consumables. You cannot foretell and see that I need this number of tissues in a month. You will not be exact. Sometimes they can be used a lot of it. Sometimes it will reduce. Those are variable costs. So let us bring on board consideration of these cost elements from our revenue expected figures. So we come and bring on board variable cost. Now, from the information after adjusting for inflation up there, we have our variable cost per unit, and then we have also the number of units. So that makes it so easy because we have everything we need. We have everything we need. So let's go ahead and compute total variable cost. We are computing total variable cost using the variable cost per unit and the number of units. So we go ahead and do that. So the number of units is 300. Variable cost per unit for year one is 73. So I just refer to that cell. After I've done that, control enter, I have my variable cost for year one total. Then I just drag to year number 4 like that. That's my variable costs for all the 4 years. And now, as we bring on board the variable costs, we know that costs reduce our revenues. Costs reduce our revenues. So I want to bring the costs as a negative so that it makes our work easy. It makes our work easy whenever we see the effect. So I just want to bring them on board as negative. I don't want to automatically adjust that because it will go overboard. So allow me to do it manually like that. Good. So I think that is okay now. So after bringing on board variable cost, what other element of cost do we have? We had variable cost and also we have fixed cost. These are costs that we are likely to incur in this projection, and we must take care of them as we try to evaluate, to appraise this project and see what are our likely returns. So we bring on board fixed cost. But before we bring on board fixed cost, you've done management accounting. And you know, whenever you deduct variable cost from revenue, whatever you get is what we normally call contribution what? Contribution margin. So let us get the contribution margin. And then after the contribution margin of this project per year, then now we bring on board the fixed cost. So let us have our work organized like that. So the contribution margin is just the net effect of these two, the net effect of these two like that. So I just autofill to year number 4. I can even put them in bold and say here, that is contribution margin, contribution margin. So now that you've done your management accounting, that is a term that is not new to you. This term of contribution margin is not new to you. Good. Now, after the contribution margin, now is when we are bringing on board what? Fixed cost, like that. Now, to bring on board fixed cost, we also have everything. The only thing is now we are building up a financial information, financial statement. Yeah, that is now what we are doing. We are building up a financial statement. We are building up a financial statement. So fixed cost, we know fixed cost, we do not multiply by the number of units. Remember, look at the language of the examiner. I want to take you back to the initial information from where the question started. You are told selling price per unit, variable cost per unit. But when you come to fixed cost, they just said annual fixed cost. There is no per unit here. So I don't expect somebody to multiply the fixed cost by the number of units. You will not be doing the right thing. Now, fixed cost is never charged per unit. Fixed cost is a cost that encompasses and includes all that is happening in that establishment for that year. So because we've now computed and taken care of inflation adjustment for fixed cost, remember what we did up here? So we just refer to that fixed cost and bring it here. So how do we do that? Year one, I just go there and refer to this 3180, bring it on board. Then I autofill to year number 4 like that. But again, because I want to deduct fixed cost, we know cost affects our revenues negatively. It reduces our revenues. I would want to bring it as negative. I want to bring it as negative so that it makes our computation easy and the flow can easily be understood. After we've taken care of all elements of cost, from contribution margin, if we deduct fixed cost, what we are getting is the earnings before we charge any interest. You have not charged any finance cost. And again, before we charge any tax. And at the same time, before we charge any depreciation. That is a profit element. It is a profit element before we charge any interest or finance cost, before we charge tax, and before we charge any depreciation. Normally, we call it earnings before interest, tax, and depreciation. That is what we are getting as the net effect from adjusting contribution margin with fixed cost like that. We are getting earnings before interest, tax, depreciation like that. That is a profit element. Now, because we've just even said it is earnings before we charge any interest, before we charge any tax, before we charge any depreciation. So now we now charge those elements that we had not charged before. We now charge those elements that we had not charged before. Now, before I continue charging those elements, I want you to confirm to me if we are moving together, all of us. For those members who attempted it, did you reach this point and do we have the same output? Before we continue to charge these elements, confirm
Yes,
we are all on board.
though I did not put the EBITDA.
Okay.
I just considered direct the depreciation.
Yes.
And then got the profit before tax.
Yes.
And then tax profit after tax, then add back depreciation.
Okay, that's okay. So I think we are going to confirm our net cash flows, right?
Yeah.
Oh, all right.
What happened? I did not consider the contribution margin. Is there an issue? If you just
No, there is
put
no.
like variable cost, fixed cost, then you go to EBITDA.
Okay, there is no problem, but it is normally good to try organize your work so that it can really, because remember, you are not only doing these things for the sake of exams. When you'll be presenting some report somewhere, you want your report to be seen clearly and understood. So that when you break it down like this, the examiner sees that this is your contribution margin. You will not charge fixed cost. You cannot treat fixed cost together with variable cost. Those costing elements are very different. So that's why it is advisable that you also handle them differently. Yeah, but really there is no problem because in an exam, the examiner is only looking at your entries. So the examiner won't go to that extent of looking at, did you name this? How did you name it? No. But it is just prudent that we do the right thing. Though in an exam, it might not. I'm using the word might not. Might is conditional. The same way we say if is a conditional functionality in Excel. So might.
Mwalimu, what if we just went direct to the question, like whatever we're doing, instead of doing the working done? Is it okay?
Come again. You go to the question without doing whatever we've done now.
No, the working one, working two, the workings we've done there upfront, we just go direct to the answer. the initial
No.
revenue, whatever you're doing.
There is no problem so long as you take care of your inflation adjustments correctly, so long as whenever you're bringing your fixed cost in your tabulation here, whenever you're bringing this fixed cost, you've taken care of the 1,000 level of precision given, and you've also taken care of inflation. You do not have to have that separate computation like we've done here, and again like we've done here. We were just doing it so that we understand the flow. We know the reference point. But really, you can do everything in one cell. So you don't have to do your workings. Workings are also not marked in an exam. The examiner is only interested in your entries. But the only important thing about workings is you can always follow and see if you did the correct thing or if you need to do any adjustments from it. But really, you don't have to do it. No one marks that. Are we together?
Okay.
Good. So let us now come and now look at note, was it note 3 or note 4? Note 3. Let us look at note 3. The company can claim tax allowable depreciation. Tax allowable depreciation on the full initial investment on a straight line. Then note 4, the company, that is about residual value. So that is okay. Now, because we know whenever we want to charge tax, we cannot charge tax on an allowable element, an allowable expense. And in this case, we are being told capital allowance, also called depreciation, is allowable. This is a capital allowance. From the term capital allowance, it's an allowable expense. So let's go ahead and say less capital allowance. Less capital allowance. Less capital allowance. Less capital allowance. I don't have to write the word less because I want to bring the parenthesis. So I'll just write capital allowance like that. Because when I say less and I again bring parentheses, then I'm conflicting my information. So I just say capital allowance. Now, capital allowance, we've computed it up there and it is a constant figure of 5 million. You remember the depreciation? That is the
Mwalimu,
allowance. Yes.
what is the meaning of parenthesis?
Parenthesis is a bracket. Just a bracket.
Oh,
Yes.
so
So now
Zoom.
we refer to our depreciation, and I'm bringing it here as a negative because we are deducting it from this our element of profit before we charge tax. So I will do that. Then I drag to year number 4 like that. It is constant 5,000. So let us less it and get our earnings before interest and tax. So now we are knocking off depreciation, our capital allowance. So the net effect is covering EBIT, including depreciation. Then we charge that. We have our earnings before interest and tax like that. I hope we are together. Now we move to the next element. We've knocked off depreciation. Let us now go ahead and knock off the next element. Do we have finance cost element here? From this question we've read and the additional informations, is there anywhere we have finance cost element? Do we have finance cost element? Do we have any finance cost element? Do we? Because I don't remember seeing any finance cost element. Let me see what
we
we are
don't.
saying. No, we don't have any finance cost element. We don't have any finance cost element. So that means even though if it was there, if we had finance cost element, we would make sure we consider it. But having our earnings before interest and tax, let us now go ahead and charge our income tax. Let us charge our income tax. And there is a note where we were told what to do with income tax. Note number 5. Tobin Limited has a no, not note number 5. That was where we were given tax. Note 2. Yeah, it is not 2. Tobin Limited pays annual corporation tax of 30% with the tax liability being settled in the year in which it arises. Do you know why the next part of that information is given? The extension after the 30%, you see the extension with the tax liability being settled in the year in which it arises. Do we understand the perspective why the examiner brought that part?
Yes, yes.
What is
It
the
is not
perspective?
accrued.
Sorry?
It's not accrued. So it affects the cash flow in that particular year.
Exactly. We are looking at cash flows. Remember, we are appraising a project. And as you appraise a project, you want to get what is my net realization? what is the net, returns that I will get? So you must make sure you take care of that charge, that tax charge immediately to see the effect it has on your cash flows. Our interest is on cash flows. So that's why that second bit was brought on board. So let us charge our 30% on our earnings so that we charge it as tax. And we want to bring it also as an expense. So I will say there, 30%, I'm putting a negative because I want to bring it in parentheses. We multiply that by the earnings before interest and tax. There. So I have my tax charge for year 1 as 2744,850. I just drag it to year number 4 and I have that. That will give us profit after tax. That gives us profit after tax. How do we get profit after tax? It is the net effect of earnings before interest and tax. Then we take care of tax like that. I drag to year number 4. So I have my earnings after tax. So for those members who attempted it, do we have the same profit after tax?
Yes.
Good. What of the others? For the others who attempted it, do we have the same earnings after tax? Or Daisy, I see Daisy saying yes. So that is good. There were 3 members who attempted it. What of the other person? Was it Eric? Lisa is also okay. Good. Lisa also got the same. Daniel also. This is very good. Eric, I think I remember some name Eric. Eric also must have tried it. Good. Guys, we're in the right direction. I'm seeing that this paper coming in April, we are likely to all of us pass this paper. If we keep the same trajectory, all of us here, in Jesus' name, no one is coming to repeat this paper. Yes, so let's continue with that spirit.
Mwalimu,
Now, yes.
repeat hapo kwa income tax kidogo.
Income tax is just
Yes.
30% of earnings before interest and tax.
But I'm not getting the same answer you're getting.
Do you have the same earnings before interest and tax like the ones we have?
Yes, I do.
So you just charge 30%. It should be the same. If you have the correct earnings before interest and tax, if you apply 30%, you must get the same answers we are getting.
Oh, I've seen.
Okay. So after that, let us now add back our capital allowance. This is a capital allowance that you've been given that you will not be able to be charged tax on. So to get our net cash flows, we must add back our depreciation or capital allowance. So we are adding back our capital allowance. So how do we add back our capital allowance? We refer to the same capital allowance which we deducted before computing our tax. So it is the same 5,000, our depreciation. We add it back. For the 4 years like that. So that now gives us our net operating cash flows. These are the expected returns as an investor. As you appraise this project, now this is what you expect to get. This is now what you expect to get at the end of the 4 years in this investment. Because you're doing an appraisal, you are working with forecasted figures to see what you are likely to get. Now, how do we get that? We're just getting the net effect of profit after tax. Then we add back our capital allowance, which you are given there. We are getting net operating cash flows. And I have my net operating cash flows for all the 4 years like that. So for the members who've done it, because you've just confirmed all of us have the same profit after tax, that also means we all have the same operating cash flows. And that means you did the right thing like that. Good. So that is our operating cash flows. Is anyone having a question up to this point? I want to believe we've all understood step by step from where we started up to this point. Now we are coming to the last part where we now ask ourselves, now that we've seen all the costs that we are incurring.
Hello.
Yes.
In case we had an element of working capital.
Yes.
That was my next question.
In case we had an element of working capital.
That is a very, very good question. Working capital. Yes, go ahead.
Just wanted to know the treatment.
The treatment of working capital. Now, if you have an element of working capital is a capital that you inject from the start of a project. As much as you are putting in your initial investment, if you are putting on board also some working capital injection at the start, you will consider it and add it as an input from the start of the project. Then, at the same time as you put it as an input from the start, when you come to the end, you have to recover it back. You have to recover your working capital at the end of the project. The same way we recover back our residual value or salvage value is the same way working capital is also recovered. And by the way, I have to look for a question that is talking about replacement analysis. Replacement analysis. You remember replacement analysis? This is something you did. You did this in FM. Replacement analysis. In replacement analysis, working capital element is clearly coming up in such a question. So I should really get a question from replacement analysis so that you ask yourself, is it viable to replace this element, this machine? For example, in a manufacturing farm, you are running with a machine and then you are being told this machine will be sold off at this point. Then they will inject some working capital from the start. After they put this, they expect to get these cash flows. They expect to reduce their working capital, their working costs, maybe variable cost or something. They will save the company some cost by this amount. Then they dispose of this machine and then they intend to, to replace the machine with a new one. And the cost of the new one is this one. And when they also bring on the new one, it attracts some depreciation element in it. Yeah. And then at the end of the project, they also dispose of the new one that replaced the old one. Now you ask yourself as a finance student, how are we going to compute our operating cash flows? What net cash flows are we going to get as we appraise and advise this company that you guys go ahead and do this replacement? With whatever figures you've given, replace this machine at this point, then now the decision will be viable. So we need to hunt for that, and I will bring replacement analysis, and it will clearly show you how we subject working capital from the start and how we recover it at the end. So you working capital, you recover it at the end, the same way we do with residual
Yes.
value, we recover. Are we together?
Question, Molib.
Yes.
These people cannot bring sensitivity analysis.
What makes them not to bring it? They can bring anything. They can bring anything.
Because we have not checked on the sensitivity analysis.
So do you know why you should not worry about anything?
Yes.
You know, this is a practical paper. Sensitivity analysis, that is being, in fact, there was a question I told you guys to try. Which question was it? There was a question, I'm just forgetting. There was a question I shared besides the, which questions did we just do the other day? I'm forgetting so fast. There was this question we did. Besides those, the file which had those two questions, the CIFA question and the one we did yesterday, there was also another paper. Was it December something, December 2023 or something? That question which I shared, it has sensitivity analysis. Do you know how they bring sensitivity analysis is very easy. It is very easy. They're just telling you favorable adjustments, because they will bring, for example, revenue, costs, for example, variable cost. They bring fixed cost like that, and then they give you scenarios. They bring it in terms of scenarios or conditions. They will say, under favorable condition, what are the adjustments that you expect? So on your revenue figure that they will give you, they tell you under favorable condition, then for example, your revenue will be affected by +5. Yeah. And then under adverse condition, your revenue will be affected, for example, -8%. You get that? So that is the model by which they bring sensitivity analysis. But again, remember, what if analysis is a sensitivity analysis tool. What if I adjust this from that name? What if? What if I subject my revenue to an adverse condition of -8%? What does that mean? This is just like applying growth rate. Applying growth rate is a very simple thing. Applying growth rate. The same procedure you normally use.
Okay.
You just
Let me
say
not be worried then.
equal to that figure, then you subject it to the adjustment. Yeah, you subject it to the
Sawa, Mr.
adjustment 1
Makau.
minus 1 plus. Are you together there?
Sawa.
Yeah, so yes,
Let me
so
not be worried, sir.
no, don't be worried at all. These things are easy. We've covered everything. Let me tell you, even if that paper comes here today, the 12th of March, you will pass that BDA paper. With what you have,
Amen.
you have more than enough. I remember giving you a breakdown of what you expect in that paper. We've done more than you need to pass. So imagine now you've not added the knowledge of auditing, you've not added the knowledge of tax. What do you think makes you not pass this? This thing is, have confidence, because we
We
are,
don't want a situation, Madam, whereby you get 7 or 8%.
sorry?
We don't want a situation whereby you
Yeah.
end up getting 8 or 7. For the
What do you
3
mean?
hours you are going to be seated there.
I don't understand what you mean. Hours you're going to be seated there as in, what do you mean?
In the exam, you sit
Yeah.
for like 3 hours, then you end up getting 7.
That is very unfair of you, Herman. Even yourself, you're being very unfair to the examiner. How do you expect an examiner to take his sweet
It
time?
happens.
Take his
It
sweet
happens.
time with all this knowledge with all this knowledge. No, no, no. We have too much knowledge. We've covered a lot, my friend. We've covered a lot. Remember, we
Amen.
started these sessions on 17th of January. And I want hey, check on what we've covered, check on the questions we've covered, and check on the class syllabus coverage contents you've done. Guys, it is a lot. It is a lot. These things we've done, now we're just polishing, we're just reminding ourselves, but we have the content. So, guys, have confidence, you're going to pass. Let's finish this question. Let us evaluate the project and finish. I've answered the person who was asking about replacement analysis, and I've just said working capital treatment, I've explained, but then I will bring to you the perspective of deciding whether you want to replace a project, a machine, or a project. We want to terminate it at some point if it is viable or not. Then that will bring on board good perspective of treatment of working capital and the adjustments that go with it, the salvage value, residual value, and all that. Now, sensitivity analysis, I've also told you, and I've told you what you've covered in what if analysis is the same sensitivity. So do not worry, worry not. Now, we have our cash flows, our returns we expect at the end of the project life. How do we appraise this project? Now, that is where we now ask ourselves, how do we compute NPV? We know very well, guys. NPV normally is the total present value of cash inflows we compare with the total present value of cash outflows. Sometimes it is called initial investment. Initial investment like that. Good. Now, with this knowledge, we already have all our cash flows here, our cash inflows, including our cash outflow from year 0. Let me also just bring on board this column where we have our cash outflows because it is our investment. This is money we are putting in, and this is the money we are looking for. Against what we are going to get, we are checking with what we invested in after incorporating all the adjustments possible so that we get to see, is our project viable? Now, let me see, I'm seeing some charts here. Ati issue ni kukumbuka. No, 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 no. No, don't worry, don't worry. You're doing well. You're doing well. Low hanging fruits, correct. 35%, correct. So if you already have 35%, what reason do you have to fail, really? You don't. You don't. You don't. Becky, what we've done is very short. It's just that we are explaining to understand. But in an exam, you won't take any much time to compute this. How long do you need to compute just this? How long? It's not much. What we've done is just that we've had to explain each and every step and exhaust all the perspectives surrounding it. But really, it's not much. We've not done much. Now, let's now do our evaluation. Let us now do our evaluation and appraise this investment. Now, additional informations. Have we exhausted all of them? Note 1 we are done. Note 2 was about tax. We've already taken care of that. Claim allowable depreciation, we've taken care of that. Number 4 is talking about residual value at the end of the 4 years. Okay. Note number 5, nominal. We are told Tobin Limited has a nominal after-tax cost of capital of 12% and a real after-tax cost of capital of 8%. Now, this is the catch. Remember, I highlighted nominal and I highlighted real. And it is very good, I remember, some good lady called Becky Lisa, if I'm not wrong, already told us that this is a feature because the lady seems to be very good in financial management, performed very well in advanced financial management. So, Becky, wherever you are, it is your time to shine. Please, in all your wisdom, give us more information about Fisher and how we are going to apply it here. And I will go ahead and write as you prepare to give us your sweet wisdom here. Fisher's formula or equation. Becky, please talk to us. Becky, talk to us. Becky, talk to us. It is your time to shine. You know, getting opportunities to shine are not very common. Please, Becky.
Becky amerudi kulala.
Becky is back asleep. Becky do not want to shine.
I'm there, you people are killing me with laughter. I am not ready to shine now.
Becky, you can't be serious. Do you know how getting those opportunities are? Look at the participants. We are 70 people here, Becky. Getting opportunity to shine among 70 people is not easy, Becky.
Ah,
I'll shine another day.
It's okay. It's okay. TMK has come to your rescue. TMK has come to your rescue. Good. Now, good. So I can see TMK is saying 1 plus n equal to 1 plus I bracket 1 plus R. 1 plus R. So that is a knowledge we borrow from advanced financial management, where we bring on board nominal adjustments. We adjust also using inflation so that we get our nominal cost of capital. In other words, we call it weighted average cost of capital, which is nominal after taking care of the adjustments surrounding it. Good. So let us come and remind ourselves of this Fisher's equation. Like the good member there said, we are just saying we know that Fisher's equation is usually 1 plus n,
I.
usually 1 plus n equal to 1 plus r, 1 plus r. We close that bracket, then we multiply by 1 plus I, which is the inflation adjustment. I believe I've gotten it correctly if my memory serves me right. If my memory serves me right, 1 plus n, the nominal, then that is the real rate, then the inflation adjustment. Then now, if we make n the subject of that formula, we should have something like, somebody tell us now the nominal, make n the subject of that formula. What do we have? Make n the subject, what do we have? What do we have? 1 plus the real rate. 1 plus the real rate.
Is this the one we did in economics?
It is the same thing. The adjustment is the same. Getting the nominal cost of capital is the same. So 1 plus real rate plus 1 plus inflation. 1 plus inflation rate like that. Then we subtract 1. If we take this one the other side, it will be a negative. So this is how we are getting the nominal weighted average cost of capital. We are getting the nominal weighted average cost of capital, where it is represented by n equals to that. So let us now put it into computation. So that we get our cost of capital, weighted average cost of capital, which now we call the nominal. After taking care of all the adjustments, how do we do it? We come there and we say, open bracket, 1 plus. What is our real rate? Let me go back to the question.
8.
It is 8. So 1 plus 8 close bracket, we multiply by 1 plus, what is our inflation adjustment? Inflation adjustment is what?
3.7.
3.7. So 3.7, 3.7, 3.7%. Oh, I forgot to put some percentage here. Percentage, we have to put it. I close bracket, then I say -1 like that, -1 like that. And I'm there getting 0.1196. We can convert it into percentage like that. And I'm seeing 12%. I can even increase the number of decimal of 12.00. So it is just 12% like that. So that is the cost of capital that we need to use to evaluate this project, to do appraisal using NPV. Yeah.
Can we just take back your cursor to the 12 I finished that term?
Mwalimu
Right.
rudia kidogo.
All right, so you can see it. My formula is active. Have you picked it up now? Have you picked it up now? Have you picked it up?
Stoe hapo mwalimu, stoe.
Mwalimu stop hapo.
All right, I'm giving you time. No worries. No worries. No worries at all. No worries at all. No worries at all. No worries at all. Are you through? Are you through? Are you through?
Almost.
1 plus 8%. 1 plus 3.7% minus 1. That is 1 plus the real rate, the real adjustment, then 1 plus inflation adjustment will give us our nominal cost of capital, nominal weighted average cost of capital of the discounting rate. Are you there? Can I proceed?
Yes.
Good, 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 good. So at this level now, all of us can now do this. We know how to compute NPV, guys. This is something that now all of us, we should know very well. Now equal NPV, because we are doing our evaluation, and the rate, we've just computed it here, so that is all we have. I just repeat the 12. Then values, value 1, value 2, value 3. You just highlight the net cash flows from year 1. Remember, it is from year 1. Value 1 is from year 1. Do not start highlighting from the outflows because we are computing NPV. That will give us the total present value of cash inflows. You see the formula I wrote here? Then now is when we compare the initial investment. But now that our initial investment is already negative, I will put an addition sign. It does not mean I'm adding. I'm subtracting, but it is because the outflows is already coming in here as a negative. So when I add positive and a negative, the result is negative. So I'm subtracting the initial investment, and that's how I'm getting my NPV of that figure, though I'm seeing it is coming with a percentage. I don't know why. Maybe some ancestors are standing between our good result we've done and bringing us this, but there's no worries. I will just change the alignment so that it is, my cursor started misbehaving, but it's okay, good. So that is the NPV. The NPV is 27,252,176. Now, if we have a positive NPV, is this project appraisal bringing us a
Mwalimu.
viable output or it is not viable?
Mwalimu nimepata 47.
Mwalimu,
Yes.
this 12% we have worked out as the WACC.
Yes.
Is it to confirm what we have in the question, or what is it?
We are not confirming because remember, I want you to read note number what? I want you to read note number 6. Have you read note 6? Not 5, from note 5.
Not fair. Yes, Tobin Limited has a nominal after-tax rate of
After tax what?
12%.
After tax what?
Okay.
Cost of capital. And a real after-tax cost of... So we have nominal cost of capital and we have real cost of capital. And again, note 6 is giving us general rate of inflation. So whenever you have nominal cost of capital, you have real cost of capital. And again, you make sure you take care of inflation adjustment. That takes you to the Fisher's effect, the Fisher's equation. And by the way, as you ask that, do we know what Fisher's equation mean? Do we know what this equation mean? We know Fisher's equation, it expresses and it gives us a relationship between, it gives a relationship between time value of money in a way that we have the nominal interest rate, relationship between nominal interest rate, relationship between real interest rate, and then relationship with inflation, right? So from the Fisher's equation, this is just an equation which was brought forward by someone. There was that scientist. The scientist was from which country? Was he an American? Was called somebody Irving Fisher. I think it is Irving Fisher. This
The American economist.
Yes, he's an American economist. Yeah, this is the person who brought us the relationship between these elements, and the elements are nominal interest rate, relationship between nominal interest rate, real interest rate, and inflation rate, or that's inflation rate, or that's inflation. So with this, taking care of all this, now that's how Fisher came up with how to adjust, how to get your nominal cost of capital or discounting rate after taking care of these adjustments. Yeah, so are we together, guys? Are we together up to that point? Are we together up to that point? Are we all?
I have a different answer.
You have a different
Please
answer?
place a cursor on the NPV formula. Mine is different.
Yes, I've activated my NPV. Look at it. Make sure when getting the first bit of NPV, where you are computing present value of cash inflows, start highlighting the cash flows from year one. Look at cash flows from year one. That should represent your value one in that formula. And you highlight the net operating cash flows from year one to year four. Close bracket. Then, when you want to compare it with the initial investment, please, initial investment I've referred to here is coming as a negative. So I'm putting a positive sign, but in essence, I'm deducting it. I'm just putting positive because it is already in negative. So remember that. If you do that, you should be having the correct output, the same as what we have.
Malim, I have a different answer. I don't know
Now
why.
it's
And our
okay.
cash flows are the same.
Our net cash flows are the same. You have all these cash flows the way they are.
Yes.
Have you checked on your NPV formula?
Yes.
You have the same
I
nominal
have 27.
SSE?
It's 12%, no?
So this you have to check your nominal. What is your nominal cost of capital?
It's 12%, no?
If it is 12%, then you should have the correct NPV.
I have 27,248,165.94.
No, there is somewhere you need to check. Check on your net cash flows. Check on your net cash flows. There is a figure. It might be 11 million, for example, in year one, but these are the figures after the 11 million. Maybe there is some slight difference. Check on them. It might be 17 million, like for example, in year two, but check on the other figures. Maybe there is just a slight difference somewhere. Check on them because you need to
6142,
get the same
36,
NPV. It should be the same.
7361310. No.
Check all of
They're
them.
the same, the figures, no?
You must get somewhere where there is a difference.
They're exactly the same.
All of them.
Yes.
So
Mine
there
with the
is,
same deduction for Haman.
yes.
You're also having the same figure for 27, 252, 176, and then NPV, the same 11 for Haman.
Are you getting the same NPV as the one I'm showing on
Yes.
the screen?
Yeah, 27 million, 272, 176.
272.
27
Oh.
million, 252,176. Same as Haman.
Then that's okay. Then we are getting the same things. That's okay. So I was asking, after you've done your appraisal up to this point, is this project a viable investment or not? And why?
It is.
It is
Because we have
viable.
positive NPV.
Because it has a positive what? Positive NPV.
NPV.
Yes. Whatever returns you're going to get is positive. And as an investor, your interest is to get profit. And because you have a positive NPV, your returns will be more than your cost. So you are getting profit, and that's what investors look for. Yes. So
I'm getting 24 million. I don't know what is the problem.
Yes, Eric, you're saying something?
I'm getting 24 million.
At NPV?
Yes.
Do you have the same nominal capital, cost of working capital?
Yes, 12%.
Then are your all net cash flows the same? All figures for all of
Yes.
them from year one to year four?
Yes.
No, if they're all the same, then there is no way There is no way you will get a different figure unless there is an input which you did. Just check well. Just take your time.
I
With
share.
with all the correct net cash flows and with the correct weighted average, nominal weighted average cost of capital, you must get the same NPV. You must get the same.
I know where the problem is, Malim.
Yes, where is the problem?
When we calculated using the Fisher whatever,
Yes.
we got with some decimals.
Yes.
But if you just type 12%, it gives you a different answer.
So why would you type 12% and yet you are computing it?
No, in the question we were given 12%, so I could just type WSC 12% on a cell.
Can I share my screen?
So okay, you should
Where
not
would you
type
get the
it in.
12% to type?
Tumia ikiwa na decimals ndio uone sio 12%. Kwa nini uchukue 12%?
We must
Can I share my screen?
just a minute. We must adjust inflation and the real rate of cost of capital so that we get the nominal cost of capital. Yeah, we must adjust it. So you cannot just type, where will you get the 12%?
So, Madimu, if you don't know this formula of Fisher,
yes,
it means that you are going to get wrong this question, and you are given the 12%
you are going to get the wrong answer. Yes.
If you don't know the Fisher's equation.
Yes. So this, the examiner cannot take his sweet time and bring you all this information in note 5 and note 6 for no reason. You see these things. The examiner could not give you this note 5 and 6, all this information for no reason. You must adjust your cost of capital. You must. So that's why that is one thing that the examiner was seriously testing. So there is no way. There is no way. Good. So I think before I give the member who was asking to share his screen, I want to believe that no one else has a problem up to where we are. I want to give opportunity to the other member. Yes?
I want to ask.
Yes, go ahead.
Is this the final answer? The NPV that we've gotten.
We are doing project appraisal. To appraise a project is to come up with a decision. We are evaluating whether it is viable or not viable. So at the point of getting NPV, now you evaluate, you're giving your final remarks and saying now the project is viable given your evaluation result. And now NPV point and giving your view and your decision is the last point to wrap up that question. So we are done with the question up to that level. Yes.
Mwalimu, thank you for that. Then,
yes.
Okay, if we didn't use the Fisher's equation, what type of NPV would it be? Because this is nominal NPV.
No, what happens? We, what we've done is just to adjust our weighted average cost of capital. Yeah. So if there is no inflation adjustment, we don't have to adjust and get the nominal. Whatever weighted average cost of capital.
So I use whatever is given.
Yes, you use what is given. Use what is given and you'll be all.
Thank you.
Concern.